If profit is growing faster than revenue, are we looking at a stronger bank or just the right quarter at the right time? When you look at this, start here. This is the base period, first quarter 2025. From this point, the business barely moves into fourth quarter 2025. Revenue grows just 0.4%, almost flat. Then, first quarter 2026 shows plus 6.7% growth. So something clearly shifted. But here's the question you want to keep in mind. Did the bank actually expand its activity, or did the environment simply become more favorable for a quarter? Now look at what actually reaches shareholders. Profit grows faster than revenue, from 7.0 to 8.2 billion. That's a meaningful jump. Think of a store that didn't necessarily sell a lot more, but ended up keeping more from each sale. So something inside the structure changed. But what exactly changed? And is that change sustainable? Now focus on costs. Margins improve, but only slightly. Costs still take more than 60% of everything the bank earns. So, yes, there's improvement, but it's gradual. And that creates a gap. Profit is accelerating, but efficiency is barely moving. So, where is that extra profit really coming from? Here's where the picture starts to connect. The bank is setting aside less money for potential loan losses. In simple terms, fewer expected problems. That helps profit. But notice something important. This can lift earnings on paper without a single new loan, fee, or transaction happening. So now the question changes. Is the bank generating more value or just recognizing fewer expected losses? Now look at the loans themselves. Charge offs, stable. Non performing loans, stable. Nothing is breaking. But also, nothing is improving sharply. So if the underlying credit isn't clearly getting better, why are provisions going down? Is this timing or expectation? Now look at where the money is coming from. Less from interest, more from fees and markets. It's like shifting from a fixed paycheck to a mix that depends more on activity. That can increase earnings, but it can also make them less predictable. So the structure of income is changing. Does that make the bank more flexible or more exposed? Now break the business apart. Consumer banking still leads, but markets is now a significant contributor. This is not just a traditional lending operation anymore. Part of the earnings now depends on capital markets activity, and that brings a different type of behavior. So the question becomes, how much of this bank is stable and how much moves with the market? Now look at this movement. Markets revenue drops sharply, then rebounds plus 34%. That's not steady growth, that's fluctuation. So when profit rises in a quarter like this, how much of that can repeat? Because volatility can boost results, but it can also reverse them. Now go inside the operation. Each employee is generating more revenue and more profit. That's real improvement. The machine is producing more with the same people. But here's the underlying question. Is this coming from better execution or simply more favorable conditions driving activity? Now break the return. Margins expand. Asset usage improves slightly. Leverage ticks higher, and this is where it deserves attention. Because leverage can amplify returns, but it also amplifies exposure. So returns are improving, but the way they are improving matters. Now step back and connect everything. Revenue grows 6.7%. Profit grows 11.4%. Markets jumps 34%. Efficiency barely moves. So here's the question that ties it all together. Is this a bank becoming structurally more efficient, or a bank benefiting from the right mix of conditions? And if those conditions shift, which part adjusts first? Revenue, cost, or credit?